Donald Trump raises worldwide tariffs up to 15%. That number sounds technical, but 15% is not small. It is not symbolic. It is structural. Because tariffs functions as taxes on imports, and taxes reshapes behavior. They reshape business decisions. They reshape consumers' price. They reshape international relationships. Informal comment here. 15% may look modest on paper. In supply chains, it's loud. Let's begin with the fundamentals. A tariff increases the cost of foreign goods entering a country. Importers pay the tax. Often, consumers absorb the final cost. Domestic producers may gain temporary price advantage, but trade never moves in isolation. When tariffs rise, retaliation becomes possible, and retaliation expands economic tensions. Now let's ground this in macroeconomics. National outputs measured by GDP. GDP reflects spending, investments, government activity, net exports. Tariffs directly influence imports. Imports affect the next export component, but they also influence consumption and business investment. Informal truth. Tariffs don't sit quietly in one equation box. Let's analyze inflation first. A 15% tariff increases input costs. Higher input costs raise production expenses. Higher production expenses often lead to higher retail prices. Higher retail prices, inflation influence interest rate decision. Interest rate decision shape borrowing costs. Borrowing costs influence investment. That is a chain reaction. Informal note: economic policy always has ripple effects. Now let's examine the domestic industry. Tariffs aim to protect local producers. Steel manufacturers may benefit. Certain manufacturing sectors may gain breathing room, but industries relying on important components face higher costs, like automakers, electronics companies, construction firms. The protections of one sector may pressure another. This is economic trade-off, not ideology, not emotion, just trade-off. Now consider global response. When the United States raises tariffs broadly, trading partners resist this strategy. Some negotiate, some retaliate, some diversify trade alliances. Retaliation often targets politically sensitive industries. Agriculture frequently becomes a focal point. Informal comment. Trade disputes rarely stay polite for long. Let's talk about supply chains. Modern supply chains are globally integrated. Components cross borders multiply times before finally assembly. A 15% tariff at one stage can multiply across stages. Business may respond by reshoring production or by relocating to third countries. That transition requires time. It requires capital. It creates temporary inefficiency, but it may build long-term resilience. Now let's consider financial markets. Equity markets typically dislike uncertainty. Tariff increases introduce uncertainty. Bond markets watch inflation expectations closely. Currency markets evaluate trade balances. The US dollar may strengthen or weaken depending on capital's flow. Informal truth. Markets react faster than policy statements can clarify. Now let's focus on consumers. Consumers ultimately experience tariffs impact through prices. Electronics may cost more. Vehicles may cost more. Household goods may cost more. Higher prices influence purchasing decisions. Purchasing decisions influence retail sales. Retail sales influence economic momentum. Yet, consumers' adaptation is powerful. Households shift brands. They delay purchase. They search for domestic alternatives. Economic behavior adjusts dynamically. Now let's examine inflation expectations more carefully. When business anticipates sustained tariffs, they prematurely raise price. That behavior embeds inflation into expectations. Embedded inflation is harder to reverse. Informal note, expectations can move markets before reality does. Let's turn to geopolitical implications. A 15% tariff worldwide signals assertive trade policy. It may strengthen negotiation leverage. It may also strain alliances. The European Union recesses supply chains. Asian markets reevaluate export exposure. Emerging economies adjust currency strategy. Global trade Flows may redirect. Redirections reshapes comparative advantage. Now let's talk about resilience. The US economy is large and diversified. It can absorb shocks. It can adapt to policy change. But adaptations carries cost. Business must recalibrate logistics. Governments must manage diplomatic dialogue. Central banks must monitor inflation signals. Informal comment. Strong economies bend before they break. Now consider small business. Many small importers operate in thin margins. A 15% cost increase is significant. Some may pass costs to consumers. Others may compress margins. Margin compression affects hiring. Hiring affects employment growth. Employment growth drives consumer confidence. Confidence drives spending. Spending drives GDP. The loop is continuous. Let's address strategic intent. Tariffs are often tools for negotiation. They create pressure. Pressure encourages concessions. Concessions may lead to revised trade agreements. Revised agreements may benefit domestic industries long term. But success depends on execution. Execution requires diplomatic precision. Informal truth. Leverage only works if the other side feels it. Now let's analyze investment behavior. Companies may accelerate automation to offset higher input costs. Automation increases productivity. Productivity can strengthen competitiveness, but automation may reduce labor demand. Reduced labor demand influences wage dynamics. Wage dynamics affect income distribution. Economic balance becomes delicate. Now let's zoom out globally. International trade fuels global GDP. Barriers slow cross-border efficiency. Slower efficiency reduce global growth rate. But domestic industry expansion may partially offset that. The balance depends on scale. Informal note. Trade policy is always a balancing act. Let's consider long-term potential benefits. Encouraging domestic production can strengthen industrial capacity. It can reduce supply chain dependence. It can enhance national security positioning. It can stimulate regional job creation. However, higher consumer price may persist. Inflation management becomes critical. Central bank policy becomes central. Monetary tightening may follow sustained inflation. Tightening influences mortgage rates. Mortgage rates influence housing markets. Housing markets influence wealth perception. Wealth perception influences spending behavior. Informal comment. Everything in economics connects eventually. Now let's address investor adaptation. Investors justify exposure. They hedge currency risk. They adjust sector allocation. Some rotate into domestic manufacturing stocks. Others reduce exposure to import-heavy sectors. Market dynamics remain fluid, but fundamentals still matter. Corporate earning determines sustainability. Productivity determines competitiveness. Consumer demands determines momentum. This drives wave headlines over time. So what does a 15% global tariff truly represent? It represents assertive economy strategy. It represents risk. It represents opportunity. It represents recalibration of global trade dynamics. It does not represent automatic collapse. It does not represent guaranteed prosperity. It represents adjustment. Adjustments create friction. Friction stimulates negotiation. Negotiation may produce new agreements. New agreements reshape trade architecture. Architecture defines long-term economic directions. The positive perspective is grounded realism. Strong economics endure policy shifts. They adapt productions. They innovate under pressure. They recalibrate supply chains. They absorb volatility. And in the end, resilience, not rhetoric, defines economic power. So tell me, what do you think about it?